Welcome to Wealth Mavericks. On today's episode, we're talking about what the stock market does well, what it doesn't do, and why high-income earners need more than market growth alone to build true financial freedom.
This is what the wealthy do. They do the buy, borrow strategy. They buy assets, they grow the assets, then they borrow off those assets. It's a tax-free event to go buy other assets. We're not asking our members to do anything we do not do ourselves. We test things out ourselves first, see the results, and then say, hey, by the way, here's how we did it.
Welcome to Wealth Mavericks. We're so glad you're here. I have Bob Wolf with me again today. Hey, Bob.
Hey, Erin. Good to see you.
Glad to have you here. Today, we are talking about a question a lot of high-income earners eventually have to wrestle with, and that is the stock market enough? The S&P 500 has created a lot of wealth for a lot of people. But for those who are trying to build real financial freedom, the question eventually becomes, is market growth alone enough? And as we were just discussing, this conversation was inspired by a prospective member of ours who said that he has watched people he knows get into alternative investments to varying degrees of success, just going after tax savings. And they actually would have been better off just paying their high taxes and accepting the slow, consistent gains of the S&P 500. That was his statement to us. And it ties well into the last episode that we just did about going after things for those quick tax savings. And we talked about how real tax planning and strategy is not about chasing those deductions or trying to force strategies just to lower this year's tax bill. And that these alternative assets we talk about are not something to be pursued just for the tax benefit. But the point today is that they shouldn't be dismissed either just because the stock market is what we're used to and what we're more comfortable with. So when you hear that, Bob, how do you respond to someone who says, am I just better off putting all my money into the stock market?
Yeah, that's a great question. So before I get started, let's start off with a disclaimer that I'm not giving investment advice. This is literally for educational, informational purposes only. So anything I say today is just for that purpose. So I think my answer is going to be the same as to, hey, I love real estate and why don't people just put all their money in real estate? Or, hey, I'm a business owner. My business is my retirement plan? Or my whole thing is that when you look at the wealthy, they don't have one asset class. They have multiple asset classes. And the reason being is that the tax code is written for each of those asset classes differently. I have multiple businesses and not all of my businesses are profitable one year over another. And so sometimes those decisions in that business create some sort of paper loss that can offset some of my paper gain. And I say paper gain because if I realize the gain, then it's taxable on my tax return. But if I can get the offset of the loss and the gain to offset each other, there's nothing for me to report in the summary of my tax return. I don't have taxable income because loss, gain. So my answer is always the same. If you're focusing on one asset class, you will always have a tax problem. Okay? The tax code is designed to create tax revenue for the business of government. But it's also written to where you can utilize the code based on each asset class and how to structure an overall plan. Why do you think people go to the stock market? Why do you think they drive people to the stock market? Because it's easy. You can go on right now in 10 minutes, set up a brokerage account through Fidelity, Schwab, or any of those companies. It's easy. But what's the main issue that a lot of doctors have besides taxes? Asset protection. Then why would you set up a brokerage account in your personal name? Why would you hold all of your real estate in your personal name? Why would you own a business in your personal name if asset protection? Because nobody's ever taught you anything different. That's the point. That's the point. You need to go find the answers. Here's the thing. With the stock market, It's not just about putting your money into the S&P 500, because the reality is, if you put your money into the top 10, you would have way greater rate of returns than the slow, consistent growth of the S&P 500. It is a tool. That's all it is. And what is a tool? To try to get you to the outcome that you want, your plan. So if you want to build wealth, you want to use the tools to help you build wealth. If you want to save money on taxes, well, there's certain areas of the tax code you'll want to use, but if you want to use the real special ones that the IRS gives you as your business partner, you want to focus on those types of assets as well. The stock market is a liquidity market, meaning that you and I can put money in and out. There's certain guidelines and structures of when you're able to do certain things called wash sale rules, meaning that you can't sell and then all of a sudden turn around and buy right away. Why? Because people would do that for a tax benefit. So they created these rules to not allow that. Okay. Why do you think they allow people to so simply put money into the stock market? And why do you think they allow people to just have that liquidity going in and out? Because it allows those that know the rules to that asset to manipulate your return, meaning their return. And real estate can be done the same way unless you own the real estate. And that's why I think that alternative asset example that you brought up about that particular potential member, there are risks with alternative assets. And we talk about that when we talk to our members and prospective members, what those risks are. There is no asset, there's no investment that is risk-free, to the point that the Securities Exchange Commission requires you as advisors and you as people involved in these assets to not say anything's guaranteed and not to say anything's risk-free.
So, as someone, and we've done episodes about assessing risk and, volatility and all of that. But as people are looking at, okay, I have this money, I'm putting it all in the stock market currently, where do I even begin? Like, what would you say the stock market does well for people, and what are its downfalls that, before we get into the next part?
Yeah. The Warren Buffett version of trading, notice that he wasn't just a stock trader anymore like he started his career. He shifted into owning businesses. Berkshire Hathaway owned businesses. They only bought stocks of companies where they couldn't buy the entire business, but they bought into or invested enough to where they had a controlling interest, meaning be able to be at the table to make decisions and have that conversation, and or those that paid good dividends because it was cash flow. So he took his original, I'm an investor, I own and buy businesses, to where he understood the value of cash flow. I think if you're an investor going in the stock market, you need to understand what your plan and your exit strategy is. The reason why I say this is that we have so many members that come to us and they're sitting there with a brokerage account in their name. They've got probably, let's say, I'll use a couple of examples where they'll have probably 80% of their balance of their account unrealized gains, meaning that they bought the asset, the stock went up, and now they have 80% of their balance is unrealized gains. If they sell that, what are they going to have? Capital gains at 20% because of their income levels. So what do they decide to do? Hold on to those. You want to know that the majority of those people don't realize that they can leverage that asset and do what we call an asset loan, which is basically get a loan and use that balance of that account as collateral for a loan. That's a tax-free event. You can still hold on to that asset. They don't know how to use their tool. Even their broker never taught them. Fidelity and Schwab's not going to call them to teach them, even though Fidelity and Schwab would get a rate of return on that. So we have members that are like, well, I bought this, and all of a sudden they're prideful that, hey, I made a good business decision. But what you did was you bought low, but you never sold high because you didn't want the tax consequence. So now you're patting yourself on the back saying, hey, look at this great rate of return. But as each year goes by, your rate of return is actually decreasing because you never bought low and sold high,
Hmm.
and then used your gains to go buy low and sell high. You are a passive investor. And so you're not utilizing the tool the way the tool could be used. It's like a hammer. Yeah, it's used in pounding nails. But if you bend over a nail, what's on the other side? There's a claw to be able to take the nail out. Well, what if you just never used that? Instead, you just like, oh, it bent over, boom, 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 and you just smashed it into the wood and you kept going. What would be left behind? It'd be disgusting, right? It would not look clean, especially if it was facing and it was going to be to the public. You wouldn't do that, but that's what they're doing with their portfolio. They're not using the tool the way it was created. So, but it is a tool, just like real estate is a tool. And so I think to that potential member's point, could they have just done that? Sure. But they will always still have a tax consequence. Because then all of it, when you hit retirement, what are you going to be? You're going to pay. You're going to have to sell it off. Well, then I'll be at a 20% or 15% tax bracket. Sure, but you'll still have taxes. The point is you'll never outrun the taxes unless you build out a plan with multiple assets. You structure it to where the tax code has you build it as a business, and you go through what we call our member evolution. Our member evolution shows how to go from that point to that prospective members to a point where there's complete financial freedom and autonomy from the tax code and wealth, basically what the wealthy have done. But it's an evolution. You have to take steps. You can't take a speed train or a speed elevator to get there. You have to take steps to get there. And there is risk associated with that. And the risk is not knowing what to do and how to do it. So you just don't do it. And you just leave your money in the stock market, unasset protected, by the way, because that's where they're at. Most of the members are at, our prospective members. So why would you do that? You spent too much time in medical school, heartache, like we talked about in previous episodes. You invested in yourself so much to now you leave the liability of everything being taken away to a stupid little fender mender on the road because this was the easiest way to do it. It was the most passive. I don't know. I'm not in agreement with that. I'm not saying it's wrong. I just don't agree with it.
Why do you think people are not taught how to use the, I guess, is it called equity? Like or these unrealized gains that you can take a loan out? Like, how come no one knows that?
Well, I think it's because they don't ask, and if you don't know what to ask, how are you going to ask? A lot of our members, right? They're smart people and they saw some success. And so I don't need a financial advisor. I'm not going to pay them a fee to tell me what to do. And a lot of times they're not wrong, because a lot of times the financial advisors aren't doing the same thing they're telling their clients to do. Right? That's one of the things you heard us say multiple times. We're not asking our members to do anything we do not do ourselves. We test things out ourselves first, see the results, and then say, hey, by the way, here's how we did it. Here's how we do it, right? It's a lot different. We eat our own cooking. So I think a lot of times they don't want to pay that fee to do so. And then the other thing is that, well, you are borrowing money using your asset as collateral. And when you get a loan, what is there? There's a cost to it. So they don't want to pay that either. The problem is they're thinking like a poor man. They're not poor. Their thinking is a poor man thinking. They're worried about losing that penny when they're stepping all over dollars. Right? And that there is a point where, yes, you want to be fee conscious. But if you could take up to, so let me explain. So if I have a portfolio of $1 million, okay, I could borrow half of it. The other half could be used as collateral. So all of a sudden I have 500,000 cash. Yes, I'm paying interest on that, just like if you were to take equity out of your real estate. Same thing. Now, what would I do with that 500,000? not buy a yacht. I'd go put into another asset. And what's that asset going to do? Hopefully cash flow and create the opportunity to have some tax benefit depending on what we're doing. And that cash flow could pay that loan back, or you could use your own cash flow to pay that loan back. None of that was a taxable event. And this is what the wealthy do. They do the buy, borrow strategy. They buy assets, they grow the assets, then they borrow off those assets. It's a tax-free event to go buy other assets. Now they have more assets they bought that they're going to grow, and then they're going to borrow after that. And all of a sudden you have this spread of assets. Well, but Bob, debt's really bad. Dave Ramsey says debt's really bad. No, he's saying credit card debt is really bad. Unplanned debt is really bad. If you don't have a plan, but if you're buying assets, isn't that a plan? If you're getting tax savings, if you're getting cash flow from that to pay for the cost of that, isn't that what you want? And by the way, that debt is not a 25, 30% interest like it is on credit card.
Yeah.
So I just think people don't know. I think people are, like I said, are kind of poor thinking in their mindset. Again, not that they're poor, it's that they haven't invested in their mind. And when you don't invest in your mind, it not from a doctor's perspective, they did there. This is totally different. This is a different skill set. It's a different habit process. It's a different muscles to build. And if you need to focus on building these muscles, you have to focus on building these muscles.
Yeah.
It takes time. Ask questions. Be vulnerable. Be wrong. And sometimes people don't want to do so.
So if someone doesn't have a terra firma in their lives, is this doable on your own? And how?
Yeah. I mean, really all they have to do is just call up their custodian, meaning Fidelity, Schwab, or whoever it is, and say, hey, I'd like to get a loan and just use my account as leverage. They won't do it to a retirement account. It has to be like a brokerage account. And then they'll tell them, okay, yeah, here's what you qualify for, right? They're going to do all that process. My recommendation, though, is don't go to the full 50%. My recommendation is to do anywhere from 20 to 30%. And the reason being, free advice, is that the remaining 50% is collateral. And if the market goes down or those underlying assets, those underlying stocks go down, there could be a call on that margin. There could be a call on that loan. And so what that means is that they have the right to sell the stocks underneath it to meet up that demand. Well, if you have unrealized gains, those gains now become realized, and now you have a taxable event. So rather than being greedy and go 50-50, you go 20 to 30% below that, you can see how the market is performing. If you're going to have a big dip of a 20 or 30% dip, you're going to know. It's not happening overnight. You're going to know. You can make the adjustments to your margin and to your loan if you need to at that time, right? But it gives you enough gap. So if I got $1 million portfolio, now I got $200,000-300,000 in cash. Yeah, go buy an asset with $200,000-300,000, get that return, get that cash flow, start paying that back, right? And that frees up that loan again. And now you have these two assets again, rinse and repeat.
Rinse and repeat. The rich get richer. The rich get richer because this is what they do. And you are the rich. So if you're only doing this one little strategy, and we talk about that too, how if, yes, you can reach a $3, $5, $7 million portfolio by saving diligently, investing diligently over the course of your whole career. And that at the end probably feels really good. And you're like, wow, I have more money than I ever thought I would. But if you look at the other path, and that 7 million could be 50 million because of these wealthy moves, big money moves that we talk about, like, would you rather have 7 million or 25 million or 50 million? But it's the mindset behind scarcity versus abundance, wealthy versus middle America, right?
Yeah. And it's like any game, I guess, if you want to say it. I mean, if you're a chess player or checkers player or a card player, right? There's a strategy once you know the rules. And you're going to deploy that strategy as long as it works every time. But what if it doesn't work every time, but it works most of the time? Do you just throw it out the door? No, you still do it because you
Right.
know it works the majority of the time. That's the same thing here, is that these are strategies, right? Joe and I were talking about this the other day, and how building our businesses went like this. It was kind of flat for a while, right? And we worked hard and tireless and put time and energy, blood, sweat, and tears into it. Medical school, right?
Mm-hmm.
Put blood, sweat, and tears. And then all of a sudden, things started to happen, and we started realizing, like for Joe and I, we partnered up. And we understand the two skill sets that each of us had complemented each other, and our personalities complemented each other. So all of a sudden, together, we became what we were trying to build separately.
Mm-hmm.
And all of a sudden, it started going like this. And then we started looking at certain aspects of the business and say, hey, that's an expense. What if we were to turn that expense into an asset, partner up with them like we partnered up? And now that expense turns into equity in the business. And so it may not create cash flow, but what is it doing to our value? It's going up, and you're multiplying that. And that is what business is. And that's what building assets are. It's using the assets, and then you start thinking and use this muscle and these strategies, and you start saying, okay, now I'm going to build, and it becomes a hockey stick. It becomes
Mm-hmm.
exponential. And instead of going from $1 million in revenue to $3 million in revenue, you're going from 3 million to 12 million. You're going from 12 million to 80 million,
Yeah.
right? And that's what happens to the wealthy. Elon Musk is what is it? SpaceX going to go public, and as the majority shareholder, they're valuing at $1.2 trillion.
Wow.
He is going to be the first trillionaire.
Wow.
But think about it. How many businesses that does he run? And he wasn't a trillionaire with this evaluation. This business is valued that way because of his success of all the other businesses,
Mm-hmm.
right? He built all these other businesses, and that all started off with PayPal. He had success with PayPal, and he started understanding and using that muscle, enhancing that muscle, tried businesses and realized and continued to improve that muscle, went public and started utilizing, and all of his business are intertwined. And you look at SpaceX, you look at AIX, you look at Tesla, you look at a Boring Company, you look at all these, they all have a unified goal with each other. So technically, if you looked at them as a singular business, like a Berkshire Hathaway that owns multiple businesses inside of it, that's $1 billion business. If you looked at all of these, it could be a $5 trillion company, but they're all separate, and they were created separately and focused their separate assets. It's no different than what we're talking about, right? But it didn't happen overnight,
Yeah.
right? And so now people are saying, well, nobody should have that much money. Well, he doesn't have that much money. He has that much value. He's worth that much. He hasn't cashed in. Why? Because he paid taxes on it.
Yeah.
The tax code didn't change. Still works. It's the same tax code for him. It's just he now has these other assets, and he can now be in control over how he does things.
Mm.
And that is the overall key and goal that we're talking about, is that I just did an episode on Asset Coach Tax Strategist on Robert Kiyosaki, talking about people have this mindset that passive income is passive. And when you're starting passive income, it's not passive. It's active. You're working hard to learn how to get passive income. But it's like the same thing when we hear that cash is king. No, cash isn't king. It's sitting there deteriorating. The flow of cash is king. But Bob, knowledge is power. No, the implementation of knowledge. It's the action of the thing you have that is the power. And so, but we always hear these little tidbits, and that, no. It's the action. You got to do something. Like Joe likes to say, we're human beings. We're not human. We're human beings. We got to do something.
Mm-hmm.
Assets are the same thing because we created them. We defined what they are. And so they're a connection to what we are as human beings. Not passive, not stagnant, very active. And you gotta work for it. It's not just happens.
Yeah. So good. And then ultimately, you are creating that velocity of money that I hear about. And when you talk about, the work that it takes and when you're on the runway, it takes a lot of work. And a lot of people never get off the ground because it's so much work. But once you get up there, then it just compounds and expands and beyond your wildest dreams. So it's like, even if it's hard in the beginning, even if, like you said, you don't have that muscle yet, it's worth putting in the work to get that eventual velocity.
Yeah. Wealth creation is like John Wayne Airport. You ever flown out of Orange County, John Wayne Airport?
I don't think I have.
All right. John Wayne Airport has a shorter runway and it has very high income homes.
Mhm.
And so what they always tell you in the announcement is, ladies and gentlemen, if you've never flown out of John Wayne Airport before, please know that we are going to take a steeper incline because of the noise regulations within these. And so all of a sudden you're going, and then it's exactly, the tail of the plane, it angles up, right? It looks very close to that it's going to drag, right? They take off and they go like this. That's what wealth creation is. It's like John Wayne Airport. When you just go to John Wayne Airport just to fly in and fly out,
Okay.
right? Then you'll understand what I'm saying is that you're like, whoa, okay. And that is what wealth building is. But how long do you want your runway to be? The more you're stagnant, the more you're not moving and trying to figure out how to get this acceleration, the longer your runway is. When you make that decision, it will be like that takeoff. Because you've actually been utilizing the rules of these assets to how they were created. But it's, again, just not happening. You got to work for it.
Bob, I need you on here every week. You have such wisdom and such passion. And this is an aside, but I said to one of my members this week, like sending a video of yours, and I know you're not going to take offense to this, but I'm like, once in a while, Bob can get a little long-winded. And he's like, no, I love Bob. I love his passion. I love his excitement. I could watch him all day. I'm like, I'll tell him that. I'm so glad to hear that. But truly, you can feel your passion behind all of this. And there's a lot of wisdom behind it. So thank you for the mic drop moments again today. So the takeaway is we're not saying the stock market is bad. It's a tool. It's one tool in your toolbox. And as your income grows, your strategy has to grow with it. And while it can be part of the plan, your money needs to start doing more than just growing in the stock market. It needs to work hard for you with greater intention. So again, Bob, thank you. Doc, thank you so much for listening. I hope you found as much value as I did. And if you did, hit the subscribe button, share with your friends, introduce more people to Bob effing Wolf, and we'll talk to you next time. Until then, go be a wealth maverick.